Hello, I'm Tony Kaye. Welcome to the Economic View. I'm joined as usual by Evan Lucas, our market strategist.
Hello, Tony. How are you?
Good, Evan. Very well. Now, overnight we had Janet Yellen speak in the US. She made some interesting comments around the Fed inflation, misjudging inflation actually, and also their program for interest rates. So let's have a chat about that.
Yeah, and I think that's probably where we need to start because there is an Australian element, as we've been talking on this sort of couch for a while now. There is a feed through. You will see it in wholesale funding. So you need to be fully aware of what's going on over in Washington. She was very strong on the fact that yes, they have misjudged inflation. They expected it to be, well and truly at 2% or even probably higher at this point in the cycle. If you go back to their 2013 forecast, so normally we talk about the dot plots, but they do also have their GDP forecasts and their inflation. By 2017, basically the end of the year, which we're close enough to, they were expecting inflation to be about 2.25% to 2.25%. So it's not there, and it's reasonably well away from that, sitting at 1.7% on a core basis. On a whole basis, it's been as low as 1.3. So it hasn't been reached, and that was part of their two mandates. What they are very strong on, and what she sort of counted in that speech yesterday, was employment. They were very, very strong on that, and they said they didn't expect employment to be as strong as it has been. So she's had an extreme on both sides, employment absolutely rocketing through, but it not translating to inflation. Now, again, if you want to bring it back here, we've got the same thing. We've got on track for the strongest employment we've seen since 2005 this year, but inflation's nowhere to be seen. So they have an interesting situation.
Yeah, very interesting. Yeah, and but the Fed's still going to continue with their program for rates.
Yep, and again, I'll quote what she said. She was very aware that this was a very watched speech, and I think this needs to be sort of put out there, that she said, look, markets can change very quickly, and they could therefore change our point of view, but the gradual rate rise is what they believe is the correct course. They believe the current conditions are there for that to happen. And she very clearly pointed out that too slow a gradual rise would actually also create financial instability. Now that's what's becoming the buzzword across not just the Fed, but across all central banks, is that the central bank's core mandate is financial stability. And that therefore means it also needs to be cognizant of overheating. And that's what she was alluding to, is that they know about their wealth side of the market. The housing market in the US has returned after their crash. All of that is moving in the right direction, and credit is still very, very cheap. It's well away from the neutral cash rate. So that's what she was alluding to. So again, looking at the interbank market last night, pricing for December is now going towards 72%, which is the highest I've seen it this year. And future expectations around rate rises into 2018, it's now hit 75% chance of 2 rate rises, not one. So one's already factored in. It's the possibility of 2 come into the year. So that is a strengthening, it's a tightening, and it explains why overnight as well, if you have a look at what happened in interest rate markets, what's happened to the insurers in the US, here in Australia, and the banks here in the US and also in Australia, they're on the up because increasing yields are positive for them in terms of a theory basis.
Absolutely. There was also some other interesting data out in the US, and that was consumer confidence data and housing starts. So consumer confidence had declined.
Yep.
I think part of that relates to the hurricanes.
It does. And there's also growing belief inside there that there is the North Korean tension issues are now hitting US consumers as well. House starts are also just moderating slightly, which again would be what the Fed would want to see. And the reason I say that is that they are tightening monetary policy. They are slowing it down. So if you want to look at it on a broader basis, if you look at the consumer confidence, it's been in optimism now for almost 18 months. It's been volatile, it's sort of been jumping around, but they have been really supremely confident in their economy. Consumer consumption has been up in the US. So the Fed would probably want to see that. They are tightening. So you are therefore reining in people's spending and the ability and access to personal credit, etc. So yes, it is a sign that there is, the 3 rate rises we've seen in the last sort of 24 months is starting to maybe filter through. But yeah, in the main, it's around the hurricanes in North Korea. But if you look at that new house starts, that's the first sign in a while that things have started to slow down ever so slightly in US housing.
Yep. So let's quickly look at a couple of things. Firstly, what's likely to happen with the dollar, our dollar.
Yes.
And also what's likely to happen with rates, we know on an official level that rates aren't going to go anywhere, but we also know that the lenders, namely the banks, are going to start ratcheting things up as soon as US rates go up.
Yeah, and I'll start with the last. Actually, no. Let's go with the first point first. So, Aussie dollar is an interesting one at the moment because I've always called it the perfect storm. The perfect storm in the Aussie dollar was the fact that we had an indifferent Fed, we had really strong commodity prices, a better led recovery in the economy than was forecasted, and the carry trade that was happening all at the same time. And it's why we went to 80 cents and have been holding quite strongly. The second one of those, commodity prices, are just showing signs of structural weakness. And we have seen just a little bit of decline. So we're now into 78 cents and a half. Again, from my perspective, though, there is still a reason why we're likely to hold above 75. Rate rises in the US will be 1, possibly 3 over 18 months. The discount that's come into the US dollar was probably more a selling of the premium that was in it from the years before. So we're probably about fair value. The carry trade is still very strong, and what I mean by that is the yield you can get in the Australian market versus borrowing in the US, or borrowing particularly in our biggest carry trade market, which is Japan, is still hugely differential, and it's very, very lucrative for Japanese and US investors in that way. So that's a positive for the Aussie dollar. That's a buying opportunity. So in the main, I still think that it's going to hold between 78 and probably as high as 82 cents. I can't see the dire forecast that some people out there of it falling to 70 cents, or as much as it'd be nice to. The catch for that is that it gets to the second part of your question. It would bring the RBA into the equation. If the Aussie dollar was to fall to 72, 70 cents very quickly, the uptick in GDP, uptick in export, pricing that we get would be huge because everything's done in US dollars. But it does, therefore, the other side of it is the banks. And we've seen in the past that when the Fed raised those 3 times, the increase that we saw in corporate markets, the corporate debt markets over in the US, put a squeeze on wholesale funding. Now, they did it very well in the fact that they targeted certain parts of the market. So they went for interest-only loans, or they went after corporate lending or investment loans in housing. If they do another 3 over the current 18 months, the net interest margin bite will be probably enough that they have to spread it across all parts of their loans. So that means also owner-occupiers would probably expect to see their variable mortgage rates increase, because if you saw a 25 to what was technically could be a 75 basis point increase in wholesale funding, that would be the equivalent for corporate rates in the US at the moment. It's about 3.25%. You're touching 4. That's quite a lot to cover, considering that the average variable mortgage rate in Australia is between 4 and 4.5%. That's break-even stuff. Now, thankfully, we're very lucky in the fact that our retail market is so strong. CBA love telling you that 2/3 of their funding comes from their own customer base, and that is great for us. But we still do not have enough liquidity to lend out at the rate that we borrow. So the wholesale market is a big part of this. So you need to therefore be aware that if you start to see some real pressure in particularly the corporate debt market in the US, which is where about 60 to 65% of our wholesale funding comes from, you will feel that through, because it will put net interest margins at the banks under pressure, and that has to go somewhere. And that, unfortunately, will probably come through to us as a consumer of loans, and you will see it. So it is a tightening situation for us as well.
No doubt, and we'll see what happens. So, thanks very much, Evan.
Cheers, Tony.
Thanks again for joining the Economic View.
Did you know that your membership gives you access to our analyst Q&A section? Every week, our Intelligent Investor analyst team answer members' questions on investing in ASX-listed companies. If you would like an analyst's opinion on your investment queries, go to the Q&A section of any of our websites to read or ask a question.